In rare market conditions, investors paradoxically view a solid financial foundation as a heavy anchor, dragging the total valuation down. Normally, investors calculate the value of a publicly traded business by looking at its market capitalization, the share price multiplied by outstanding shares. That number represents what the operating business and its assets are actually worth. At 90 cents, MNDO's market cap is $18.5 million. Subtract $13.8 million in cash and zero debt, leaving an enterprise value of $4.7 million. This nearly equals the $4 million in annual free cash flow. The math suggests an anomaly. Subtracting net cash from the market cap implies this 30-year-old operating business is essentially worth negative dollars. To evaluate this pricing, an investor must objectively weigh the structural decay of the core business against the mathematical floor provided by its balance sheet. The market is responding to clear operational signals. The core legacy business is actively shrinking, and profitability is rapidly compressing. This maps the top-line damage. Revenue peaked at $26.3 million in 2021, contracting to $19.4 million by fiscal 2025. The decline hits the bottom line harder. Operating margins compressed from 26% to 11% over that same window, and the bleeding hasn't stopped. Management recently disclosed an impending threat to their recurring revenue model. A major customer submitted a formal non-renewal notice. Come March 2027, a contract responsible for 15% of total revenue will disappear. Replacing lost revenue requires winning new contracts in the telecom market, but the sector is rapidly evolving, and MIND's architecture is heavily outdated. This graphic illustrates the technology gap. MNDO's legacy setup operates at a 51% gross margin, which looks low next to modern cloud-native competitors like Cerillion, who command margins above 80%. The legacy platform is stalling out, while the rest of the telecom software industry accelerates past it into cloud-native environments. They cannot engineer their way out of this deficit. With zero open job postings and a quarterly R&D budget of just $1 million, they only have enough capital for maintenance, not structural transformation. For decades, investors looked past this technological lag because the company functioned as a reliable cash machine that paid out massive dividends. Depending on the entry point, holding this stock delivered annual dividend yields between 10 and 19%. It was a purpose-built income vehicle. Then, in 2025, the board pivoted. The dividend was suspended and replaced with a share repurchase program. Pulling the dividend effectively fired the existing shareholder base. Institutional yield chasers initiated a mass exodus, dumping the stock regardless of the underlying book value. The resulting negative enterprise value is an extreme pricing outcome. The market is discounting the stock because management has been transparent about the decay of their legacy model. But if you look strictly at the top-line contraction, you miss the quality and stickiness of the cash still moving through the system. Underneath that shrinking surface revenue, a highly efficient closed-loop system is constantly filtering and capturing capital without a single internal leak. Between 93 and 96% of their $19.4 million revenue is recurring. To maintain that pipeline, they spent only $27,000 on capital expenditures last year. Compare that negligible outflow against $4 million in operating cash flow. And that cash is real. This management team reports strictly under U.S. GAAP, without adjusted earnings, manipulated EBITDA, or creative accounting tricks. This conservatism dates back to the 2008 financial crisis, which forced the management team to prioritize liquidity and capital preservation. Pre-crash, MIND parked 2/3 of its assets in auction-rate securities. When the market froze, their investment with Credit Suisse was written down to zero. They refused to absorb the loss. Management filed a FINRA arbitration claim and clawed back $18.5 million from the banking giant. Then they turned around and sued their own auditors for $5 million, citing gross negligence. Since that crisis, they have moved entirely into unencumbered cash. That vicious, protective DNA is an asset for investors. When this executive team warns about a client departure nearly a year in advance, their bluntness allows for accurate financial modeling. The combination of cash conversion and capital protection establishes a reliable, hard mathematical floor underneath the current valuation. Maintaining a public listing is expensive, Compliance and exchange fees place a disproportionate financial burden on a business generating only $19 million a year. Operating independently as a microcap in the telecom business support system sector is becoming structurally difficult as consolidation sweeps through the industry. Mid-market players are being swallowed. Optiva went private for $110 million. CSG was acquired for $2.8 billion. Plot MIND here. At a $4.7 million enterprise value, buying this company is just a statistical rounding error. An acquisition practically finances itself. A buyer gains immediate access to a sticky European customer base and can use the company's $13.8 million cash pile to offset the purchase price. Consolidation patterns suggest a larger entity could absorb this self-contained unit simply because it fits perfectly within the sector. Even if an external buyer doesn't emerge immediately, the company is executing an internal catalyst through a $2.4 million share repurchase program. Management is now using corporate capital to retire stock at a deep discount to the company's stated book value. Retiring shares at 90 cents, when those shares are backed by a much larger pile of net cash, increases the intrinsic per-share value for every remaining investor. Between the high public exchange overhead and the depressed market price, remaining independent is becoming financially difficult to justify. The case for MNDO rests on the objective calculation of market mispricing, rather than on the hope of growth. The debt-free balance sheet acts as a vault door, definitively locking out the catastrophic downside risk scenarios that often plague competitors. On a single framework, the asymmetry is clear. The downside is a hard floor of cash and zero debt. The upside is open. Buybacks or M&A could reprice the equity. You pay 90 cents for a share backed by 68 cents net cash, generating 20 cents free cash flow. Management has documented the client departures, and the institutional yield chasers have already fled. The worst-case operational scenarios are already factored into that 90-cent price tag. To see a return here, you do not need the company to capture massive new market share. A catalyst for a deeply undervalued asset does not require miraculous growth. When a profitable, cash-flowing asset is priced below its own net cash and liquidation value, the ultimate catalyst is a reversion to fundamental financial math.